Powell will have to be accommodative. He will have to bring rates down. That means, the dollar's going to get weaker inherently. But gold is, gold has so many reasons that it's disconnecting from its standard pro and con cases or bull and bear cases. It doesn't really matter whether rates are high or low, whether the dollar's weak or strong, whether they're positive or negative, whether there's inflation or deflation. Gold has been reaching all-time highs in circumstances where typical headwinds for gold. And the reason gold is doing well is it goes back to that amorphous topic I've said at the beginning, trust. Trust is in everything is disappearing. It is a metric that the rest of the world doesn't trust the US IOU and the US dollar like it did in my father's age or my grandfather's age.
ING Bank expects gold prices to hit fresh highs in 2024 and to average $2,100 in the fourth quarter, with a 2024 average of $2,031 on the assumption that the Fed starts cutting rates in the second quarter of 2024, the dollar weakens, safe haven demand continues amid global economic uncertainty, and central bank buying remains at high levels. MatthewPiepenburg, co-author of Gold Matters, notes that economic challenges may weaken the dollar, while gold remains resilient, reaching all-time highs. He discusses petrodollar concerns, noting the decreased appeal of the US dollar in Treasury due to significant debt. The petrodollar is not as stable as it once was in 2023, and the US may need to reaffirm its position in light of recent changes. There have been a number of noteworthy signs pointing to a potential shift away from the dollar and toward other currencies, especially in light of the apparent policy changes. Regarding geopolitical shifts since 2014, Matthew highlights central banks transitioning from net buyers of U.S. Treasuries to gold. Central bank attitudes toward gold started changing following the 1997 Asian financial crisis and the 2007 and 2008 financial crisis. Since 2010, central banks have been net buyers of gold on an annual basis. According to the World Gold Council, total gold demand hit a record last year and is expected to expand again in 2024 as the U.S. Federal Reserve moves toward cutting interest rates, potentially aiding prices. As per Matthew, weaponizing the reserve currency against nations like Venezuela and Iran sparks distrust. Smaller nations feel it immediately, while China and Russia show growing discontent. Apart from abandoning the U.S. dollar in its trade with China, Russia is also urging the BRICS organization to develop financial relations and make mechanisms for settlements within the bloc. Now, we present the clips of MatthewPiepenburg's insights from his recent interview with David Lin. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
And what I'm certainly not going to predict, or it's a mug's game to say, well, the petrodollar's days are over, because if that were true, that would be devastating to the US dollar. It would be extremely good for gold. And as bullish as I am about gold, I don't see the petrodollar ending anytime soon. But think about certain implications right now. You have to understand, it wasn't a foregone conclusion when Nixon got off the gold standard. When he took away that chaperone, now the US president, the White House, could print as much money as they wanted without having to back it by a certain storage of gold. That created a massive boon for every president since to monetize or spend to get reelected with money printed out of thin air. But at the same time that they decoupled from gold, Kissinger was running around the OPEC countries trying to convince them, please make sure that oil is bought in US dollars. We need demand for that US dollar because we don't have gold anymore to give it credibility. But if oil can be bought in gold, that's great. So while Kissinger was trying to convince them to do that, Volcker was raising interest rates by 15%, 18% to make the US dollar look sexy, to make the US Treasury look credible. OPEC said, okay, fine. Now we have a petrodollar. That was 50 plus years ago. Well, today, in 2024, the US dollar isn't what it used to be in 1971 or 73, and the US Treasury isn't as loved. And we can't. Volcker could raise interest rates by 15% to make that US Treasury and dollar more attractive. Powell cannot, because unlike 1973, we have 34 trillion in public debt and counting. We have the Congressional Budget Office right now predicting another 20 trillion in IOUs in the next 10 years. So we do not have the luck or the good fortune that Volcker did to raise rates to make our U.S. Treasury attractive. And so we're seeing OPEC looking differently. Again, the handshake with Xi and the fist pump with Biden. At the same time, since 2014, and this is not a gold bull conspiracy theory, central banks since 2014, net sellers of U.S. Treasury, net buyers of physical gold. These are clear and convincing signs of a slow but steady shift away from the US dollar, which was accelerated when we weaponized that against Putin. What was supposed to be a neutral reserve asset. Friends and enemies alike of the US, the home of that reserve currency, raise their eyebrows in distrust and say, like Saudi Arabia. You're seeing that now. You're seeing pseudo friends of the U.S. pulling away, not overnight, not tomorrow, slowly but surely, death by 1,000 cuts, away from trust in the U.S. dollar and the U.S. Treasury, because we've weaponized what was supposed to be neutral. You can do that with Venezuela and Iran. You can't do that with China or Russia or other large countries. And that's why larger countries are saying, we've imported your inflation since 1971. We know you're the biggest, guy in the block, but now you've gone too far. And that is why we're having the theme, not the end result of de-dollarization, rising slowly and steadily. That's why when Biden, after calling the Crown Prince of Saudi Arabia a pariah state, he got a fist pump while Xi got a handshake. Saudi Arabia now is doing more deals with China than it does with Europe and America combined. Again, it doesn't mean Saudi, which is pegged to the US dollar, is going to leave the petrodollar or leave the dollar. But the direction it's going is clear and convincing to me. And it's something we should be concerned about, because if that petrodollar loses any of its strength, then the dollar loses its strength, because the world is slowly turning away from the dollar. Again, 80% of trade settlements is US dollars, 70% of global GDP measured in the US dollar. There is no doubt that the US dollar is still supreme, but its hegemony is irrevocably lost because its trust is irrevocably lost. Once they weaponize the world reserve currency against Russia, whether you were in favor of Putin or Zelensky is irrelevant. Once you weaponize the US dollar, trust in that neutral currency ended overnight, and it was going to be irrevocable.
You've studied the... Sorry, please.
This goes trust across the board, whether it's trust in your media, trust in your government, trust in your dollar, or trust in your foreign policy. It all comes back to this politicization, this weaponization, and people are losing trust.
MatthewPiepenburg underscores the U.S. dollar's weakened purchasing power from global distrust. He predicts inflation if the U.S. keeps issuing IOUs, relying on the Fed's printed money. The annual inflation rate in the United States has increased from 3.2% in 2011 to 8.3% in 2022. This means that the purchasing power of the U.S. dollar has weakened in recent years. However, he foresees a Fed policy shift, emphasizing the need for rate cuts to support bond repricing. Treasuries slid in Asia Monday, as Powell's comments underscored the likelihood that bond investors had overshot in pricing for rapid rate cuts. Benchmark 10-year yields climbed 5 basis points to 4.07%. The greenback held gains over all Group of 10 peers, with the Bloomberg Dollar Spot Index rising as much as 0.3%. Foreseeing a sacrifice of the U.S. dollar, he warns that Main Street citizens may feel the impact of reduced purchasing power. Let's get back to the interview.
This is where I agree entirely with Brent Johnson and Daniel Martinez. It's not as if another currency is about to replace the US dollar, ever, or anytime soon. And when I talk about a multipolar, a multi-currency world, it's also multi-dysfunctional. That's not necessarily a good thing. The US is weak, but so is China, so is India, so is the rest of the world, so is most of the emerging markets. It's a global problem. So the US is still the best horse in the glue factory, or the best patient in the ICU, which gives us this debate about DXY, which is still absolutely the US dollar. For liquidity, nothing better. For preservation, gold, nothing better. And the US dollar is relatively stronger, although the Swiss franc's even better. I don't think the DXY ever goes to 140 again, but it doesn't matter if the DXY or the dollar is stronger, its inherent purchasing power is weaker. No one trusts it. And if the US is going to issue another 20 trillion, even without a recession in the next 10 years, who's going to buy that IOU? Nobody. Enough. There's not enough natural demand. That means the Fed will have to buy that IOU, that US Treasury with printed money. That's fiscal dominance. That's ultimately highly inflationary. That's the endgame. After the regional banking crisis at the beginning of 2023, we called the BTFP program buy the frickin' pivot. Everyone thought Powell would pivot in early 2023. The markets projected it. I projected it. They would cut rates after that crisis in the bond market, because the regional bank crisis of 2023 was a bond crisis, not a banking crisis. It just was. And now, I do think, though, this time the market is right. There's going to be a rate cut. I don't think there'll be 7 or 8. And here's the reason why. We have $740 billion worth of bonds that have to be repriced on the S&P. S&P names that have to reprice their debt in 2024. In 2025, another $1.2 trillion in corporate bonds that have to be repriced. They need to bring those rates down now, before those bonds roll over. When they roll over and have to be repriced, the higher for longer policy, that would have been devastating. So for one thing, Powell had to cut rates to save the S&P, some of those names, because their debt was rolling over. Uncle Sam's debt over the next 36 months, there's over 30 trillion in US Treasuries that were going to have to be repriced. You need a lower rate to do that because Uncle Sam can't afford higher rates. So Powell has no choice. He has to bring rates down. He has to give some support to the give some support to borrowers, basically, or issuers of debt. Because the simple fact is, if rates stay too high for too long, it kills everything but the US dollar. And so it's time to make a pivot. I don't think we'll see 7 or 8 rate cuts. I could be wrong, but we will have to see some. And I think there's just so much pressure on all these other markets, from real estate to stocks to bonds. They can't handle 2% positive real rates. They can't stand higher rates. So Powell has thrown in the towel long before he hit target 2% inflation, because the bond market can't handle his higher for longer policy. So to your question, I'm bullish for now on even the projection of rate cuts. I'm bullish for now on Powell being accommodative to the S&P. Short of an extrinsic event or a headline, I joke cryptically, and this is cryptic, you could have a nuclear bomb go off in Cleveland, and the markets could still go up as long as the Fed is accommodative, as long as the Fed is supportive. Because that's how divorced natural market forces are from reality. And because the Fed is, sadly, the market. And you can go back in Q3 of 2022, Q1 of 2023, you can find scenarios where when rates got too high, the bond markets just destroyed themselves. It was crazy. The volatility was crazy. They couldn't stand higher rates. And so the Fed will have to accommodate the system. It has to accommodate the bond market, as the bond market also affects the stock market, it affects the pension market, it affects the currency market. Throughout history, this is the key issue, you always save the system, bonds, at the expense of the currency, always, without exception. So the US dollar will be sacrificed at the end to save the US Treasury and to save the US system. And so who will be hurt the most? Main Street citizens, whose cost of living goes up. You can inflate the S&P too and get higher returns, but you're going to be measuring those returns on the dollar that has less and less purchasing power.
Many investors look to gold for stability when the economy and global political scene appear uncertain or volatile. That uncertainty could play a significant role in the price of gold this year. How do you envision the evolving economic landscape shaping the future of gold prices and global currencies? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.